Okay, so wanted to make a video before I go to good old work here. I'm going to be working late tonight. I work in the healthcare field, not in patient care, but healthcare field. And so this happens. Um, Here we have, I was watching Real Vision Finance, but I can watch this on the drive up to the account, which I'll be leaving soon. But we need to talk about the economy. So we had, this is something, that I'd like to try to maybe help people understand what's going on, in a way that they can understand it. Because, it was very hard for me to get into the finance sort of world as far as the reporting is concerned, because it just uses all sorts of esoteric language. Now, one of the best places you can go if you're interested in learning about this stuff, and I think every American should be interested in learning about finance and markets at least a little bit, is Investopedia. I hate saying Google because I dislike Google so much. Search for Investopedia. It's basically an online finance encyclopedia with spectacular articles, easy to follow, in layman's terms. And then my next suggestion would be just dive into it. Just start watching videos. Just start watching, whatever you want, whatever you need to watch. Start small and work your way up. So, what I wanted to show first is what we have right here. Let's start with this. There's no particular order I have to do this in. So I have two charts here. And I don't know why it did that. So first chart is your 10-year yield. Notice we have an interesting pattern. These technical analysts would be drawing lines from here to here and doing some weird stuff. And, I don't really care about all that technical analysis. I mean, I think it's useful. I just haven't really got into it yet. I'm still learning fundamentals of macro and all that. But they have a name for this where it goes up, peaks, goes down, goes up, peaks, goes down, goes up, peaks, go down. So this is an indicative of what they would call a trend upward in interest rates. 10-year yield being, according to all the smart people out there, basically the benchmark interest rate. So now we got this little ditty right here, which will be this guy. This is the best information I could find on short notice on the Federal Reserve's asset purchasing program. So this is basically a way for the Federal Reserve, which basically has limitless ability to spend at the moment because they can just print money, or the Treasury. Maybe it's the Treasury that prints the money and gives it to the Fed. I don't know the details, but basically they can just make money come out of thin air. And what you want is, in our current environment, our current sort of fiscal situation, you want interest rates to remain low. Because that keeps the economy moving, because credit, it allows people to borrow money, everybody from the businesses and the government all the way down to the consumer. As many people know, we have a debt-based economy, which many also would argue is completely unsustainable, right? So, given that, what the Fed does is buys bonds. So how the bond market works, it's like kind of the inverse of the stock market. Bond prices go up, bond interest rates go down, supply and demand. If bonds are worth more, the people that are issuing the bonds don't have to give as high of an interest rate, and vice versa. If bond values go down, interest rates go up. So there's that dynamic. Now, in the bond market right now, the problem with the bonds is if, say, you have a 10-year bond, interest rate on that bond, going back to our other table here, right now, since the 10-year treasury is 156, 156 basis points, 1%, 1.56%, that is your interest rate on a 10-year, well, that's the yield, but that which is a little bit more complicated, but just think of that as the interest rate. So that kind of serves as a benchmark for interest rates throughout the economy, because the 10-year yield and all the treasuries are considered the safest fixed income, the safest bonds. So that's going to be basically the floor of any bond. Now, corporate bonds are going to be higher because so the corporation has to give out a higher interest rates in order to coax people into loaning them money when they sell the bonds. So that would be basically your lowest possible interest rate. And most interest rates are based upon that. So we got that part out of the way. And we got the part out of the way that interest rates are basically the only thing sustaining our economy right now. There's nothing being there. Well, there is, it's a misnomer to say we don't manufacture anything in this country. We are still one of the largest manufacturers in the world. We're in the top. I think China might be above us, but we're still in the top 5. But we just consume so much more than we produce. And that's kind of where needing debt in order to maintain that consumption comes in. That consumption is what supports the entire economy, people going and buying things. So the Fed wants to make sure those interest rates stay low. That's kind of the concept of quantitative easing. That is the concept of quantitative easing. And this whole concept of taper, if you've heard about that, if you're into the news, the financial news at all, the whole concept of taper kind of revolves around the Fed not purchasing as much assets. Because right now, the Fed is, and I'll get to this in a minute, the Fed is purchasing about 120 billion per month. At least that's their maximum that they can purchase. I'm going to take a drag off of my vape. So I just wanted, so I saw this little pattern right here, and I said, and my suggestion, my sort of intuition has been that the Fed is doing what they can to keep these bond rates down. So they go up, the Fed purchases more bonds and brings the bond market back down. It brings the yields back down. It actually brings the prices of the bonds up. So that's something you want to go on Investopedia and research on your own, because I don't have time to explain it here. It took me a while to wrap my head around that. Okay, so then you go to this little chart and you can see exactly what's happening. Now, I did it in a very simple manner. I didn't have time to go on like TradingView and overlay these charts or anything. So here's from federalreserve.gov. There's a site actually called FRED right here, which is actually pretty good. But I'm not sure if you can get this particular chart on FRED. So here we have, where was it? Let me show a good, September 22nd, we have a decline in the balance sheet. The Fed offloaded some of its assets. It's probably, there's nowhere in here where it says how much they're purchasing, but I'm going to assume that they're purchasing less. in this particular case. If anybody knows where to find out where they're purchasing assets, I don't think they give that much transparency in the Fed. I think they don't make it public, or they don't make it public right away. They don't release the data on what assets they're purchasing. They're all going to be bonds or mortgage-backed securities, CDLs, probably collateralized debt sort of instruments. So the balance sheet dropped from 848 to 844 billion or trillion. So that's about 40 billion less assets. I'm assuming, and I'm going to continue to assume, that they didn't actually buy as many assets at that time. Well, look what that's. Oh, geez, what just happened there? Okay, I got it. So 8 blah 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 blah. Now I just screwed it up somehow. Okay, so let's go back. This data only goes up until August 20th. So here's September 22nd, September 29th. They had 40 billion less assets on their balance sheet. I'm sure they didn't purchase as many, if any at all. Now let's go here. September 22nd to 29th. Well, looky here. Bond, the 10-year yield went from 133 basis points to 154 basis points. At the same time that the Fed's balance sheet went down. Interesting. Now we can see here from the September 29th to October 6th, and so let's say September 29th to October 13th. Let's go back to our September 29th to October 6th. It stayed basically level. Now, it gets a little wonky at this point. So maybe here, it looks like they increased their asset purchases even more, and we'll see what they do when they release the rest of the data. It looks like they don't want to, the data, it takes a little while for it to get released. Let's see. So we're still in October, and their data basically goes up to October 18th. Why is this? Yeah, I want to put that there. I'd like to put this particular window, I'd like to put here. Okay, that's better. So from September 29th to October 20th. September 29th, October 20th. Goes up a little bit. We went through one little peak, but then it went back down. They were still purchasing assets, and then they increased their purchases of assets between the 13th and the 20th. Let's see what happens between the 13th and the 20th. Here goes the 13th. Boom. It stayed mostly level. It went up a little bit, but I think you could see that what my thesis here is that the Fed is trying to keep interest rates low based on what I'm seeing here and here. And they're not succeeding. And the problem is bonds want to be higher than the rate of inflation. Now, the bond market was stupid enough to believe the Fed that inflation was transitory. I guess because they forgot about Arthur Banks. And they forgot that the Fed is basically a political institution. And Most of these people are fucking boomers and they watch CNBC. Let's be real. The most of the hedge fund managers, most of the traders out there, the bigger traders, these people are all boomers. They're fucking into the mainstream media. They're gonna believe what CNBC says. Now they're starting in, August. It looks like they saw several months going back to really February of increasing inflation. Then the July number I think was really high. August number wasn't as bad, but the July number was zero point 0.9, wasn't it? Okay, and you can start seeing a difference in the behavior of the investors right here. So my thesis is that the Fed is attempting to and failing to keep the interest rates low through their asset purchase program. And then we have this talk of taper. I think they already realize they will not start tapering in November. They say they're still going to taper. The Fed says Powell says he's still going to taper. I have my doubts. I don't know. Really, at this point, I give it a 50-50 chance. The thing is it looks to me like they may want to increase asset purchases if they want to keep the ship afloat. But that would only keep the ship afloat for a little while longer. Once these interest rates run away out of control, I mean, and think about this. The CPI is full of shit, and most people know it. I mean, everybody says that really, is honest, says that the CPI is full of shit, and that it probably underestimates inflation by half. So we really, honestly, if you wanted a bond to be held to maturity to, not lose your money, you'd want a 10% coupon rate, not a 1.5% coupon rate for sure. So it's at the point where the treasury bond in its, original intended use is basically useless. And the only thing it's good for is as collateral or for trading on the secondary market. So I think, my prediction, since, I want to make these videos mainly to just set out some predictions, and then I'll be able to show people later on. I think this interest rate situation is going to run away from them a little bit. I think that we're going to get another bad job report. When is it coming out? Next month? No, next week. Yeah, next month. Next week. The jobs report is coming out. Let's see. It said right here on Fred, this website. We're going to go to this website because it's a good website. Fred, F-R-E-D. It's run by the Federal Reserve, but it's like their research. It's a good website. You have to give them credit. Sometimes, when you give the government money, rarely, occasionally, when you give the government money to do things, they actually do something good. So this is actually excellent. They aggregate all of the economic data from all of the agencies. So it's basically a one-stop shop for all of your economic data. And I think it was Wednesday the 3rd, no. Wednesday the 3rd, no. Wednesday the 4th, Thursday the 4th. One of these days next week is a little lag. This is the calendar. So unemployment insurance weekly, I think on Friday, unemployment situation. So that's going to be the report for the previous month. That is going to be bad, or not much better. It's going to be I think it's going to be probably a little better than last month's. I'm sure their expectations are much lower now. And I'd have to see, what are the expectations jobs report. September. Oh, that'd be October jobs report. October jobs report. Where are we at on time here? 19. Let's keep it under 30. October jobs. This is an old. What is this? What are you doing, Yahoo Finance? Is this from like last year? what is this from? Yeah, it's like from 2018. Okay, so expectations. We go to news. We go to past week, and then we say, yeah. So that was the kind of what got me on this topic was. So you have your GDP. Let's forget about the jobs report. Now at least people know when it's coming out, where to find it. So you don't have to wait for Reuters to come out with an article that they will definitely sugarcoat the situation like they have been. So they're saying U.S. economy slowed to 2% rate last quarter in the face of COVID. Negative. Did COVID? Where I don't know. Listen. I don't think that COVID has had as big of an impact on GDP as they're saying, but they've been using COVID as an excuse for everything. Now, where are their businesses closed down? I mean, maybe the less intelligent people in this world, or people that have bona fide health concerns, which is very few people in terms of the population. So either one of those two groups might have not gone out as much. How much of the population that is can't be more than 25%, 20%. They still, engaged in online shopping. So GDP going down 2%, and that's and the expectation was 2.8%. So that they want to say COVID, and everybody wants to say COVID for everything. They say we had the recession last year because of COVID. No, we didn't. We had recession last year, the shortest and deepest recession in history, because the governments around the country, at the recommendation of the federal government, then run by President Trump, suggested shutting down the entire economy. So it was the government response to COVID, and I was screaming from the rooftops about it. And it turned out to be a huge mistake. And the people that pushed for him and kept defending him until early this year, they'll never admit that they were wrong, you know. But we're still feeling the repercussions of that. I think that it's kind of like when you hit your head and you're kind of discombobulated. Like if you, let's say you get knocked out or something, and you're not right for the rest of the day, you know, disoriented, head injury. That's basically what we had. We had a head injury last year, and it was a government self inflicted head injury. And it was a mistake. It didn't stop the spread, it didn't alleviate the depth of the pandemic. Okay, so bullshit. I call bullshit on that. And they're not going to be able to blame COVID for the from here on out. I think this is the last time they'll be able to seriously blame COVID and get away with it. And I think the fourth quarter, it all depends on the political situation and what kind of shit they do politically. Is Biden going to stick to his vaccine mandate measure? And is it going to be what he said it was going to be back in August when he announced it? That would cause massive chaos. I tend to believe that he's going to actually pare back. He's going to say that he's doing it, but it's going to be a much more pared back policy that's not going to affect nearly as many people. It's going to leave religious exemptions over, which will make it moot. This happened. That would make the whole point moot, because this happened before with the flu vaccine only, let's say, 20 years ago, if that, where they tried to force people to do it, especially in healthcare, mostly in healthcare. And I've worked in healthcare since before then. And everybody started claiming religious exemption. And eventually, and at first, the government and the companies and all the different, whatever agency was behind it, They pitched a fit and they pushed back and they tried to deny people their right to a religious exemption, but they got taken down in court like they are right now. There's cases all over the United States. Breyer shot down one in Maine, but he didn't shoot it down with prejudice. He said they can they can refile the claim, but they have cases all over the country. Breyer's the most liberal judge, so of course he's going to go for vaccine mandates because he's probably friends with Biden. But we have a 5-4 majority of conservatives. The religious exemption will stand. So it'll be a moot point, and I think that OSHA knows that. So maybe they're going to leave it open for religious exemptions, which then, in that case, everybody's going to claim a religious exemption because anybody, even someone who doesn't follow a organized religion, or even somebody who follows an organized religion that doesn't specifically ban the vaccine mandate or has anything to say about the vaccine mandates, even anybody for any particular reason can file a religious exemption, and that's the way it should be. So there's that. How is that going to play out, and how will it affect the labor market and the broader economy? I think that the political policies have already made the situation worse. Will they reverse course? We'll see. Politicians tend not to want to admit that they are wrong, obviously, because there's no benefit to admitting you're wrong. There's only downside. But continuing with policies that obviously don't work is even worse than admitting you're wrong. So just quietly don't do it. Quietly change the policy. Release a policy through OSHA that's basically toothless, and then claim victory. That's what this was all about anyways. I think they knew that COVID was going to do what it did, what it's doing right now, which is like any other cold. It has spikes, it goes very fast, and then it burns itself out, kind of like a forest fire. Some are worse than others. So they said, we're going to do this right now. We wanted to divert from Afghanistan in August, so we announced this the next day after the disaster in Afghanistan, just to kind of get people to rally around him in his base. And then he can claim later on that he cured COVID. And there's enough really dumb people. Excuse me, I don't want to say retarded. Retarded is not a good word to say because that may offend people who have disabilities. There's a lot of idiotic people who will believe that. Most of them are fucking boomers. So the second thing that's going to happen is where my prediction is. So we'll see what happens with that. I think personally he's going to go forth with the policy, but it's going to be essentially toothless, and it'll probably get struck down in court, aspects of it. We'll see. But that's not good for the economy either way, to release these broad sweeping overreaches of federal government in the workforce. But the second thing is the employment situation won't be to the Fed board's liking, and they will decide not to taper. Or if they do taper, it'll be a very, very small amount, basically nothing. And I think that interest rates will continue to go up regardless because nobody believes the transitory talk anymore. And with the infrastructure deal, I don't expect there might be a jump in the stock market if it goes through, but other than that, the infrastructure deal, most of that money is getting wasted and handed out to political cronies, and the rest of the money that's not being wasted or stolen is going to be spent over 10 years on various projects. I was watching Daniel DiMartino Booth. I love her, and she was of the opinion. So I'm taking this opinion from her that the infrastructure package that Obama put through didn't do much for the economy, as we remember. That's because most of that money that the government spends is wasted or stolen, and what little is actually put to productive use. And then also, now the big deal is if they increase taxes. Now that won't be something we start to see the effects of next until next year. But I think this year, as I said in the previous video, I think the absolute floor for month over month inflation is 4%. I think interest rates will continue to go up and down. I think that the Fed's taper will be basically toothless. I think that the OSHA mandate for vaccines will probably also be toothless. Or maybe they'll delay it again, and hopefully people forget about it. I think next week's jobs report is going to be pretty bad. Of course, not as far below expectations because the expectations are going to be lower. Okay, but it's not going to be good. Okay, so that's my video for today. I am out.